And this is where we get to see who has the staying power or who's here for the drinks. Hands up. No. Well, hello, everyone. I am absolutely delighted to have the privilege of closing out what has been a super informative and insight-packed day here at Emergence London 2024. And what better topic to end on than the outcome that most funders and founders are so often focused in pursuing: exits. So I'm Gareth. I spent about 20 years in industry, building a group of engineering equipment and consumables manufacturing, distribution, and training companies, largely through M&A. It's a mature sector. We sold that in 2019 to a NASDAQ-listed Scandinavian-based private equity firm. Stayed with that for a while, and then I went portfolio as a NED, a chairman, a consultant, an investor, working with leaders at all stages of the business life cycle: startup, scale up, and sell up. And I've since worked with investor groups, funds, programs in the VC and PE spaces over the last 4 or 5 years. But as a pedantic IRR-focused investor, I've observed some interesting trends, some exciting emerging opportunities, and some rather alarming economic challenges, a few of which I'm here to talk to you about this afternoon. So buckle up. And we've got half an hour. This is probably going to take me about 15, 20 minutes, and then think of some questions to keep me interested, busy. Let's go. Let's get into it. So, conference season is definitely in full swing. And this week, GPs have been gathering for some mutual hand-wringing and mea culpas in Berlin at Super Return and Super Venture. Now, nobody wants to catch a falling knife. And so during the macroeconomic inversion that we've been faced with for the past 18 months or so, no manager has actually wanted to risk investing at a premium during a period of multiple contraction where the underlyings are attracting less in terms of enterprise value. So if it hasn't been a sure thing and there hasn't been a clear upside, it hasn't been getting funded, period. Now, largely that paralysis is partly due to multiple expansion having been the norm during the bull market area. And it might surprise you to hear that actually about 50% of private equity value creation over the past decade has actually been due to multiple expansion, riding the wave. So managers of all kinds have probably been quite rightly questioning whether their model still functions when the music stops. And that's meant that despite having record amounts of capital committed but not deployed, capital allocators in funds have been somewhat waiting for the wind to change. So, I guess I'd imagine those stationary cupboards have been pretty well organized over the last 12 months. But currently, $3.2 trillion of unsold assets are hindering capital returns due to, ultimately, the cap being on, the lid being on, fewer IPOs, and consequently reduced M&A volumes down the value chain. And as a result, there's $2.6 trillion almost of dry powder as at the end of Q1 this year sat unallocated. So according to Preqin, the average total value to paid in capital, for example, in venture, was measured in recent years at about 3.5x. And magically, that number correlates very much on track with the number of the private placement memorandum that was circulated to LPs in the decade previous. However, the bad news is that the all-important distributions to paid-in capital are at comparative historic lows, having achieved, again, according to Preqin, about 1.7x over the decade from the GFC to the pandemic. So what does that do for distributions? Well, we know that delivering liquidity is ultimately the critical challenge of private market alternative asset classes. And this needs to be carefully balanced with not prejudicing or reducing, in fact, maximising future returns. Yet, with regard to the wider private equity space, the severe constriction of capital that we've been seeing has painted a very bleak picture, and you can see the decline here in recent years in terms of distributions to LPs. So how can managers across the PE/VC space convert their TVPI to DPI and move us out of what is effectively Schrodinger's ROI as we currently sit here? Is it or isn't it going to be a unicorn? Into tangible distributions for LPs, assuming, of course, that the managers want to do that. One hopes they do. Hey, George. So, well, some are actually actively engineering exits, which is reassuring to hear as an investor, in whole or in part, by better preparing their portcos, by bringing buyers to the table, by trading out in secondaries, by leveraging, good old leverage, or, dare I say it, actually driving the talent in their holdings to deliver revenue growth and margin expansion, albeit there's comparatively little of the latter tangibly impacting performance. So as I mentioned, the IPO window has been closed and is only now starting to creak open. And you can see the effect that that's had just on the FTSE in recent weeks. But meanwhile, for some, M&A has remained a go-to strategy and often targeting US trade acquirers in order to achieve a premium. Secondary market transactions are somewhat booming, but often at a discount. Management buyouts with either debt or mezzanine fund backing are also on the rise, and equity release through partial exits are sometimes also entertained by managers. One can only hope that by taking this more proactive approach to portfolio management, that funds will reverse the direction of this chart instead of relying on the correlation with the macroeconomic confidence to deliver a result. So, given this rather woeful general performance, and mindful that alongside state funding, key institutions such as our pension funds and insurance firms comprise a significant proportion of limited partners whose capital is at significant risk of an underwhelming IRR, one perhaps has to ask the question of whether past UK government's obsessions with concentrating capital to make Britain a unicorn factory in order to perhaps buoy the FTSE over a period of time might have been a tad reckless. Time will tell. Time will tell if many of those companies actually choose to list on the FTSE instead of pursuing more capital overseas. One hopes that we can repatriate some of that at some point. But what if I was to tell you that there's another way outside of just focusing on those two poles of the market, the innovation economy and the listed companies, to engineer some sustainable growth in our economy and to fuel public market outcomes? Because in just focusing on those two poles, innovation and blue chip, a whole swathe of value-creating, stable, established, boring companies employing a significant proportion of the UK workforce are basically being casually ignored. Perhaps because individually many of those independent companies just aren't of a material size to matter. But in aggregate, their contribution and frankly their potential is quite staggering. Hands up if you've heard of the phrase Mittelstand. But you've lived in Germany.
I went to Germany once on holiday.
It does. The Mittelstand. Let me give you a little graphical representation of what goes on in my brain and also in Dali when you talk about the Mittelstand. Day in and day out, real goods and services are being produced, distributed, supported, maintained by small and medium businesses. It might interest you to learn that only 26% of active companies, so there's 5.7 million companies, I think, around that on Companies House. Only 26% of active companies on UK Companies House actually employ anyone. So according to the Office of National Statistics, 23 million jobs depend on about 1.3 million employers, many of which are small businesses. In fact, most of which are small businesses. And the balance sheet of these companies, and more widely across the developed world economies, these balance sheets of these SMBs contain trillions of dollars of asset value. Now, why can't we access that? All too often that's locked up because there are no immediate obvious routes to liquidating it or routes to gaining economies of scale. And releasing it appears at first glance from a model to require a disproportionate amount of effort, which I'd like to say isn't really a fair assessment. But as we chase larger and larger material fund values, we get further and further away from these sort of real companies doing most of the economic stability work. Now, the much-loved multiple expansion game that we play in these private equity and large company and VC spaces can actually also be achieved through SMBs with just a little bit of creative thinking and some good old-fashioned hard work. And this is perhaps one of the biggest and most often overlooked opportunities for upside available to us in the current economic climate, right this moment. Because today we stand on the brink of the largest generational wealth transfer in history. A generation of baby boomers to whom much value has accrued are basically retiring as we speak. And in the States, that's about 11,000 people a day. Now, over a third of UK SMB directors are working at or near retirement age, and 15% of them are actually working past retirement. And it's estimated that 50,000 British businesses are potentially for sale every year. But there was a recent survey conducted which identified that 28% of UK SMB owners are either actively considering selling or are open to doing so. And that equates to 330,000 companies. Whoa. Now, the problem is that only about 2,500 companies in the UK change hands every year. That's a long way from 330,000. In fact, 10 times more companies go into liquidation every year than are actually acquired. And that, my friends, is a travesty. Now, if our incoming new government fails to address the economic continuity risk posed by this SMB succession challenge, it will leave the UK vulnerable to an unprecedented undermining of its largest employment segment. And the consequences of that could be pretty catastrophic. Here's how. Because, as per previous slide, small to medium business owners employ about 60% of the workforce. Here's the cost. There's about 17 billion in NIC PAYE, about 49 billion in VAT, and about 25 billion in CT. That's just the cost in fiscal terms every year from those lost companies. And if those 1.8 million people employed by 330,000 companies were to not get another job because the companies have gone into liquidation and maybe there's a sudden spike in unemployment, there's 68 billion of welfare costs to the state. So we have a potential 160 billion pounds per annum risk on our hands. If the owners retire, or worse, die, without finding any successors to take their companies forward and consequently wind them up through a CVL, this is the eye-watering impact that we could see. So just taking into account that that's just the bottom line impact, if you look at the 2.3 trillion of estimated combined revenues of those companies, the lost earnings would equate to about a 4% impairment to UK GDP. Now, that, for context, is equivalent to wiping out all the growth we've achieved in the UK post-pandemic from one overlooked part of the economy. But it's not all doom and gloom, and I'm conscious that it's Friday afternoon, and I don't want to leave you on a downer. I'm not responsible for your mental health. So as Newton said, for each action, there is an equal and opposite reaction. And so enter ETA. Anybody familiar with that phrase? Quick hand in the air. Oh, fantastic. So give me a moment, please, to just explain to you what ETA and it isn't estimated time of arrival, although there's a gentle irony to that. Come back with me, those who were alive, to 1983. Irving Grusbeck, a professor at Harvard Business School, developed the model of something called a search fund. Anybody heard of a search fund? All right. So search fund at that time existed to assist graduates from business schools in acquiring and operating small businesses. So rather than go out and start a company, it was go and buy a company. Because the principle was really straightforward and repeatable. Many owners of fundamentally sound companies in the US were approaching retirement age and seeking to liquidate the value that they had created over their career. But they hadn't put in place any succession plans. And so young, capable entrepreneurs with the requisite capital and the right advisors had potentially the opportunity to find, acquire, innovate, transform, and grow these businesses. Arguably an endeavor that's slightly less risky than being a startup founder. I can see all of you that look like you've prematurely aged on the path to trying to find funding and customers and all the fun that goes with it. Perhaps buying an existing business due to the company's assets and their continuing trade could be seen as easier. So they put this to the test, and the first search fund was Nova Capital, which came out of Harvard Business School in 1984. Nova Capital. Now, over a period of a decade, their acquisitions of established businesses netted their investors a 24x return. 24x return, we can only dream of such things. It's almost like angel returns, but without the 90% death rate. Amazing. So at that point, galvanized by that outcome, and Nova Capital being celebrated as alchemists, entrepreneurship through acquisition, ETA, was officially born. And it has been steadily growing in popularity in the 3 decades since. It gradually made its way across the pond, and so it's now taught in eminent European institutions like IESA in Spain and our very own London Business School. Also at INSEAD, for those of you with a half-decent MBA. And whilst still very much in its infancy in the UK, it already has spawned a movement, a rapidly growing set of communities of what are called searchers. And so there's groups like the Harbour Club and Dealmakers Academy and Kong Club and a bunch of other folks that are, in a peer-to-peer sense, helping each other to acquire established companies. Now, in a nod to the original search fund, Europe now has its own Nova Stone Capital Advisors out of Benelux, and they've actually got their own incubator for ETA. So it trains and sponsors ambitious entrepreneurs, typically either former operators or graduates, business school graduates. It helps them in their acquisitions by providing skills and capital and mentoring and support. So ETA is starting to come of age. Now, as with all exciting emerging investment trends, new models and new permutations of how to engineer value creation in this space are being drawn up and experimented with on a regular basis. So it feels nascent, frankly. But one of those models, one of those playbooks for being able to create value, particularly if you're raising money from LPs, is valuation arbitrage. This has a clear path to multiple expansion. Now, typically colloquially termed the roll-up, which makes it sound like it's some form of sushi or a tobacco product. It's probably not exciting, not as exciting as either of those things. But it's an aggregation and consolidation play, which solves for the inherent fragmentation in this particular space. And it delivers a spread through the building of a group or a holdco. And it, the more I read into this, the more I realized I've been unwittingly doing this in all the M&A that I was doing back in my industrial career, how I built a company, and then wondered why they paid me 6x to exit it. There is basically this here value chain, this pyramid that's formed of some strata. And there's a broad base of SMBs at the bottom. And then there's degrees of private equity fund sizes, culminating at the top in public companies, which typically achieve around 15 times EBITDA in their enterprise values. And imagine then that there's a waterfall downwards, because at various different stages of materiality in aggregate earnings, increasing valuation multiples are paid in M&A. The further up the pyramid, the bigger the materiality, the lower the risk of the entity that you've built through consolidation, the more people are going to pay you. So you can earn a significant return through playing that valuation arbitrage game if you've got the stones for it, because you can buy at 2x, you can aggregate, and then you can sell to mid-market private equity at 8 to 10x. Nice spread, but not for the faint-hearted, but a very worthwhile return on effort, something that VC could be proud of, or only aspire to in some cases, except for the outliers. So often with only minor refinements and improvements required to the underlying holding subsidiary companies, you can deliver some upside without having to do much major surgery because, again, the valuation arbitrage, the multiple expansion comes through scale. So smart searchers are actually building these holdcos, often with a heavy dose of leverage, because why not, to achieve this outcome. Now, in the US, this is actively facilitated by the gift that keeps on giving, the US Small Business Administration. Many fortunate Americans in the room? Sir, I applaud your government on one particular issue, the SBA. Government-backed M&A loans, 90% loan to value, 10-year terms. What's not to like? Now, the Americans are ultimately acutely more aware than the Brits of the economic continuity or discontinuity risk of SMB succession. And these loans provided by approved lenders are ultimately government underwritten. So throw in an SBA loan and a healthy amount of seller financing, which what we Brits would call deferred consideration, and you've got a trend that has driven some pretty exponential growth in ETA as a movement stateside. Here in Blighty, the conditions aren't yet quite as favourable, despite our good friends, the British Business Bank, having stated mission of supporting sustainable growth and prosperity in the UK by making finance available to small businesses. Sounds pretty clear-cut as an objective. Actually, no comparable facility currently exists from them. They're patient capital into a number of funds. In fact, they spawned a whole vintage of VC funds in the UK. They have a reasonably well-intended but poorly executed regional angels fund. They provide startup loans, very great source of capital for founders there. And they presided over C-bills, so the less said about that, the better. So we live in a hope, we in the ETA community live in the hope that Mr. Starmer and Ms. Reeves, should they be fortunate to gain the support of the electorate, might be able to squeeze SMB succession funding into the BBB mandate. So, all very interesting, but why, you may ask, is Gareth bending my ear about all this, and why does he even care? Well, I care because, despite going portfolio, I've had this unscratchable itch to get back to acquiring companies. And so when I started looking for off-market candidate companies to approach, it quickly became apparent that finding them and finding how best to contact their owners was needlessly difficult. And at that exact moment, BizCrunch arrived in the Block Dojo. It's a venture builder that I serve as investment director for, so I'm equally guilty. And I was fortunate to be invited to join their team alongside two other amazing co-founders with sector expertise and deep sector knowledge. Now, BizCrunch basically offers tools, data, services, community for searchers and sellers of SMBs, with the aim to ultimately reduce the cost, time, and complexity of buying and selling small businesses in order to hopefully achieve a significant increase in UK M&A to start before it expands into other geographies where the same challenge is evident, and with the intention to bring down the number of at-risk unsold businesses and try and solve some of this economic challenge. Now, we're not entirely altruists. There's a lot of money to be made in this space, as many of you will know. And we owe it to our fantastic angel investors who participated in our $250,000 pre-seed last year to deliver them a return. But if we can play our part in helping the UK economy to mitigate the continuity risk of a generation of retiring business owners, we'll leave a legacy that we can be proud of. And by pursuing your own entrepreneurship through acquisition journey, so could you. So why not explore this emerging opportunity either directly through acquiring a business or two or four, or by investing in a search fund as they start to become more prolific and deliver clear returns to LPs. And that way you can experience the alpha that this sector is set to generate for yourself. So if you'd like to dive deeper into this topic or see how BizCrunch or ETA in general is going to make it easier to get started finding companies to buy, then here's my LinkedIn on this lovely QR code. My DMs are open, and I love meeting new searchers to share thoughts on this exciting space. I will bend your ear for longer if permitted. So I guess in summary, I hope you've had a rewarding day here at Emergence London. Thanks for sticking around to hear from me. Appreciate your attention. We've a little time left, and I always love a left field question. So if I've piqued your interest, please throw some at me. Sir at the back.
Gareth, the difference between the United States and the United Kingdom is the fact that the United States is a union of 51 states. UK is a conglomeration of 4 countries.
Almost. Sometimes, on a good day.
There was a comment made earlier about productivity comparisons between the United States and the UK. And one of the factors that hinders international investors from putting money at scale in this jurisdiction is they feel that business acquisitions will not be as productive as they are in the United States. How can that perception be changed, if it can be changed?
Well, fundamentally, the population of the UK is somewhat less, I think 5 times smaller than the US population. And that's market limiting to some extent. But in context, the valuations of the companies reflect that to some extent. As does, I imagine, the veracity of the investment appetite of American investors versus the more hesitant European-esque approach to investment that we take here in the UK. I think proportionately, the gains are true both sides of the pond, because we do have a properly functioning strata of private equity acquirers that are looking for more opportunities to spin companies up the value chain and make their own spreads. We have a relatively liberal, open, free market economy driven approach. Some might say slightly less regulated than some of the US states in terms of being able to operate, so for example, blue collar businesses without having to have a state issued license. Ultimately, what you need is good public indemnity insurance and some qualifications and some skilled staff, and let the free market determine whether you are a competent company that is going to serve your customers well and survive. So is the market size an inhibiting factor? I think that's priced in, is probably the answer. Does that answer your question? Supplemental.
Yes. So I'm talking about trade buyers from countries like Qatar, India, that come in. You see a lot of the Middle East money in flagship projects that can spin around, but you don't see another JLR which the Tata Group acquired at scale. So how can we ensure that the next tier of acquisitions is taking place so that a Dr. Reddy Labs from India is acquiring assets here?
Absolutely brilliant question, and I guess brings me to the point, which is we only have a finite size of material, a finite number or pool of material sized companies. But yet we have all this disaggregated sea of smaller companies that could, with a little bit of effort, become the next listed entity. You're speaking to a problem that we're facing, which is ever larger fund sizes in order to attract the better economies and the larger institutional sovereign wealth funds, for example. And fund sizes get bigger with every cycle, right? There hasn't been one specifically focused at this stage, but with 2.5 trillion of combined revenues, there probably should be if there's that sea of opportunity to choose from in aggregating SMBs. Sir in the cap. Hey, Sean. Yeah, take your point. Very different proposition. I think IP and the value that accrues to IP over a period as a company scales is very much a venture prerequisite, shall we say? Does that exist in the same way in SMBs? No. Arguably, their brand value and NPS is probably about as much intellectual property as they have bothered to pursue thus far. But again, it can come with scale. I think part of the problem of this disaggregation and fragmentation is that there hasn't been enough capital pooled to try and create the opportunities to innovate in some of those spaces. Because, if you look at electrical contracting, for example, there just isn't a UK nationwide market leader. It's very much a fragmented, localized, regional play. But you've got all these individual companies doing ultimately the same thing, but inefficiently because they haven't necessarily been brought together to share some back office costs and some research and some process optimization, etc. Yeah, and why do they talk about that? They talk about that because that's where innovation is coming from. That's where the unicorns are born, in that golden triangle between Oxford, Cambridge, London. And it's true, but you've got the Northern Powerhouse, which has been spoken about, and that ultimately has a lot of locked up hidden value in its private sector companies that's not had the same fair access to capital, arguably, as the unicorn factory of the Golden Triangle. So yeah, you make a very good point that more could be done. Great, thank you very much.